Yeah, in this session, let's look at a basic introduction to investment in commodities. Why people started considering investment in commodities is better is one of the good options that is available to them. What are the various benefits associated with commodity investing, and how do I typically measure the returns that are associated with investing in commodities? So these are some of the base prime elements we will try to look at in this session. So just before we get into the details of understanding the various aspects specific to commodities, what I would like to look at is over the last few years we have been observing that the commodity prices are increasing year over year, and especially in developing countries like China and India, the commodity prices are growing year over year, and it is even projected that this trend is going to continue for the next few years. So, because of this reason, an investment in commodities is typically looked at as a beneficial model, which could add a lot of value to the investor alongside his investment in traditional investments like stocks and bonds. And people generally, historically, when you look at the performance of the various commodities, their returns were equally good to the traditional investments like stocks and bonds, but with very little layers of volatility. Even that is adding up as an additional factor, or probably a good diversification factor, or even a good alternative to the typical traditional investments. And what we also see is the correlation which they have with the typical traditional instruments is very, very low. And as we can appreciate the fact, the lesser the correlation with a particular class of assets, the better the diversification advantage they give. So even from a risk reduction or a portfolio diversification perspective also, the commodities are giving a good benefit to the investors. And finally, they are treated as a good hedge against inflation, because in general, the definition of inflation itself is an increase in the price of various basket of goods and services over the current price. And most a decent composition of the basket is the essential commodities itself. So when I say the inflation is high, obviously the commodities prices also should generally be higher to a large extent, which means even though my purchasing power is going down, but my cost of commodities is going up, which means I am not losing so badly, which means the investment in commodities is actually acting as a better hedge for me. So from all these dimensions, people generally go forward looking for investing in the commodities. And just like any other market, just like any derivatives market, even the commodity derivatives market also has three major groups of investors: hedgers, whose intention is to reduce the exposure to the risk. So here in the hedgers also we look at two major categories of them. One, the sellers of the commodity, or probably we call them as producers of the commodity. So someone wants to sell oil, so he is producing oil, and so for him, he generally goes on a short hedging position. Means he wants to lock the price, lock the selling price. That means he is taking a short hedging position. So the seller of a commodity is one category of hedgers, as well as the buyer of the commodities. Who is the buyer of the commodity? Primarily that particular companies which use that commodity as a part of their industrial process, as a raw material in their business. Those kind of companies, let's say we are talking about gold as a commodity. Gold as a commodity is used in various industries. So the buyer of the gold means the buyer of the commodity which goes into the cost of production. They want to make sure that the price of gold does not rise in future. So they want to go for a long hedge, which means they want to protect themselves against the rising prices. So the buyers of the commodities generally want to protect themselves from the rising prices. So they try to get into a long hedging position. Whereas the seller of the commodities, they try to get into a short hedging position because they want to protect themselves from the falling prices. So whenever a person or a company is having an exposure to the underlying commodity and wants to protect itself from either the rising prices or falling prices, that kind of a position is called as a hedging position. So simple way to talk about the hedging position is, I have exposure, any company which has an exposure in the underlying commodity market and is taking an opposite position to protect itself from the falling prices or rising prices. That is where we call those kind of participants in the commodity or derivatives market as the hedger positions. Whereas those set of participants who don't have exposure to the underlying physical commodity at all, who are neither buyers of the commodity nor the seller of the commodity, but still they get into the trading of that particular commodity to make profits out of the betted prices. So they try to bet the price of the commodity in some direction and wants to, based on their understanding, and based on that they would like to make the profit if the prices move in their direction. So they are typically taking the risk out of the hedgers. So when hedgers are reducing their risk on that commodity, speculators are increasing the risk. So basically the other way I should put it is, speculators are taking the risk of the hedgers, or hedgers are transferring their risk to the speculators, and because speculators are taking the risk on behalf of the hedgers, they generally charge a premium. We'll talk about this aspect. They generally charge a premium, which is what would be reflected as a part of the futures prices. Then there is a third category of investors in the commodity market who are called as arbitrageurs, whose intention is to make riskless profits by trying to benefit from the mispricing of the assets in various markets, various geographies, various time zones. They want to benefit from the mispricings of the same commodity in different markets. It could be because of time difference, spot versus futures differences, or the market 1 versus market 2 differences. They want to benefit by the mispricing. So they generally sell the overpriced commodity and buy the underpriced, because the underlying commodity will still be the same, whereas because of various reasons it is priced differently in different markets and they want to take an advantage out of it. The most common kind of an arbitrage mechanism we see in the derivatives mechanism is the cash and carry arbitrage. The simple logic is, as per the typical equivalence or futures rate parity theorem, you should see that the futures price is spot price times E per RT, continuously compounded risk-free rate of return. So whenever either in reality the forward price is greater than this formula or less than this formula, they either get into, if it is greater, if the forward price is greater than S naught into E power RT, arbitrager quickly he sells a forward contract for this price. He buys the commodity in the spot market by borrowing this much amount at a risk-free rate of return R, which means at the end of the borrowing period he has to pay only S naught into E per RT. But today he has frozen the contract, saying he can sell the commodity after a certain time at F naught, which is greater than S naught into E per RT. The difference is what he is directly making a profit. So arbitragers look out for the mispricings or differences in the prices of the same commodity in different markets at different points in time, and basically try to lock their profits without taking any additional risk. That set of investors in the commodity market, that set of participants in the commodity market get classified as arbitrages. These are the three major categories of participants we see in the commodities market. Then, what differentiates a commodity market from any other typical traditional investment market? If I look at the stocks or bonds, they are generally treated as financial assets or capital assets. Whereas when we talk about commodity, it is a physical asset. So there is something to do with the storability, right? Different commodities have different levels of storability, but when I say storability, it's something to do with the degradation. For a few days or few months or few years it can be stored without any degradation, and at the same time the cost of storage is not so high. Then we say this particular commodity is storable. But every commodity that I am trying to evaluate needs to be checked from the concept of storability. So by storability, what we are trying to understand is the degradability of the product and the cost associated with the storage. Then we are also looking at a specific feature of commodities, which is the renewability. Can this product be renewable? Means can the same product be produced again and again? Means, let's say if I talk about a crop, I sow the seeds, I get the crop, and again from the crop some seeds come up. The same seeds can be used for regenerating the crop, which means it's the same set of seeds which follow a cyclical manner. Seed gives rise to a crop, and crop contains seeds, and again those seeds give rise to additional crop. With those kind of products typically are called as renewable products, renewable commodities, whereas some other commodities once consumed they cannot regenerate, they are non-renewable kind of products. So the pricing or the evaluation for non-renewable products, the price is purely based on the current spot price, whereas when we talk about renewable products, even the future expected cost of production goes into the current price, because these things will give rise to the raw materials again, which can be used for regenerating the same product. So the future cost of production also is bundled as a part of the current price for a renewable commodity. So any commodity which we are trying to evaluate, we need to be very careful of whether it is renewable or not. That's one more specific feature along with the storability that is associated with commodities. And as is the case with the storability, different commodities have different levels of renewability nature also. And one more dimension that is worth looking for commodities is the convenience yield. Very interesting aspect compared to many traditional securities. This is primarily from the perspective of a comparison between holding the physical commodity versus the equivalent long position in the futures contract. See, from a company's standpoint, let's say if it is having a commodity, it can decide when to use in the production, especially from the consumer company's perspective. Let's say it has two choices: either buy the commodity today and store it in the inventory, or buy the commodity in future itself by locking the price by getting into a long futures contract. Now, out of these two, which one is comfortable? For that, what we are saying is, if at all the commodity has been in the inventory, the company can think of using it whenever it wants, either today or after 1 month or after 3 months. But when it is thinking of buying the commodity exactly after 3 months by getting into a long position, even if it gets an opportunity to produce that product by using this commodity within the next 3 months, it cannot do it because the commodity is not available. So that kind of a monetary benefit that the company is getting, especially from the perspective of the buyer and the user of the commodity. So whatever is that monetary benefit which the company is getting by holding this commodity rather than holding an equivalent long futures position is what we are calling as a convenience yield. And generally, one major scenario is the availability of a non-renewable resource. Sometimes if it is known that in future this particular commodity may not be available that frequently, which means the price of the commodity may go up very drastically in future. It's not about just the price, even the availability is an issue in future. If that is the case, the company still think holding the commodity today itself is an advantage rather than holding a futures position or something, because of the lack of availability, perceived availability of that commodity at a future date. So that is what is giving rise to a convenience yield. And typically what we see is there is an inverse relationship between the inventory levels and commodity future prices. If the inventory levels are very, very high, we expect that the commodity future prices will typically go down and vice versa. And this is giving rise to something more. Any good that is storable, highly storable, inventory levels will be high, because I would like to store that particular good. Inventory levels are high. If the inventory levels are high, future prices of commodity are less. So if the future prices are lesser, there is no point in holding the commodity today, means there is a very less convenience yield. Convenience yield is coming out to be much lesser, because I'm not able to, there is no need for me to hold on to the commodity today, because in future the prices are going to be much lesser. So better I can go and buy it at that point itself. So what you see is any commodity that is more and more storable, we see that the convenience yield associated with it is much lesser and vice versa. So whenever we are trying to evaluate commodity investments, the focus has to be looked at from this specific dimension also. Then, whenever we are trying to value the commodities, we should look at them from three different dimensions. This is an important classification. So what we should look out for is, from a commodities perspective, we should see whether, or not even the commodities perspective, any asset which we are looking at from a valuation standpoint, we should see whether it falls in the category of capital asset or a consumable asset or a store of value. Every asset that we see in the real world, they should be classified into one of these three forms. When I say capital asset, I am investing in this and it generates a regular cash flow, at least for some predefined period, and it can be sold off at the end of some period, typically like your stocks and bonds. They generate continuous cash flows. So whenever we are doing the valuation of such kind of assets, we can go with discounting the future cash flows to their present value. So whenever we are talking of at what discounting rate I should go with and all, I can use standardized models like CAPM, which will give me the expected rate of return based on the risk that is associated or that is linked to a particular index. So that is the characteristic of capital assets which generate cash flows for you in future. Whereas on the other side, we look at consumable assets. They are not capital assets. They don't generate any cash flows in future. Commodities, most of the commodities fall under this category. They have to be consumed. So their valuation cannot be done based on a CAPM approach or the discounted cash flow kind of approaches. It has to be purely done based on the demand and supply, which means for most of the commodities, the pricing is purely done based on the demand and supply, and no DCF model can be used for pricing the commodities. Then we have a third category of assets which are called as store of value assets. So they can't generate any kind of regular cash flows, nor they can be consumed, like the artworks. They are just a store. I cannot generate any cash flows out of them, or I cannot consume them. Similarly, the real estate which is owned by the owner, real estate which is rented, obviously is a part of capital asset, because I can somehow project the cash flows that I can get in future and use the discounted cash flow method or any other real estate valuation approaches to find out the value of that particular real estate which is used for a rental purpose. But real estate which is owned by the owner, which is occupied by the owner, it's very difficult to quantify the value of it. The same way with the artwork. So those kind of assets typically go as store of value, and we are not getting into any kind of valuation mechanisms for that. But the typical thing about this product called gold is it can be treated into any of the three categories. It can be treated as a capital asset because there is a leasing or renting which can be possible for gold. So because of that leasing scenario, it can be treated as a capital asset where regular cash flows can be generated out of it. It can be treated as a consumable asset because gold is used as a raw material in the production of various goods and various goods. So it is treated as a consumable asset from that dimension, and it is also treated as a store of value because of the preciousness that is associated with it. Neither I will sell it nor I will consume it. So then it is becoming a mere store of value. So gold is one such kind of a commodity which is not the same as any other typical commodity, but it can be classified into any of the three types. So the valuation of gold purely depends on what is the kind of use that it is being put to. Then Okay, now comes, if at all any investor is interested in participating in the commodities market, what are the ways in which that particular person can participate or enter into the commodities market? The first one is a straightforward one, a direct purchase of a commodity. Gold, silver, any of the precious metals or anything, I can simply buy it in the spot market. Right? So that is a direct purchase, which is very obvious to understand. But there exists a big disadvantage. It is not diversifiable because it involves a huge outflow of cash. So diversification becomes very difficult with that kind of a model. And storage as well as maintenance costs are very high. For example, I purchase gold. I have to store it. There is a huge storage cost involved with it. The maintenance expenses are much higher. And if I purchase gold, I consume a lot of money. It means I'm locked up with the any other purchases because my cash flows are almost dried up. So it is not much of a diversifiable mechanism getting into a direct purchase of the commodity. The other way which people enter into the commodities market is try to purchase the shares of a commodity producing company. So let's say I talk about a company which is producing sugars. So either I could invest directly in the sugar by directly purchasing it, or probably let's say there is a company which there is a public listed company which is into selling gold ornaments, which is listed. So instead of directly purchasing gold, I purchase the shares of that particular company which is listed on an exchange and whose shares are listed. So that way I am getting exposed to the commodity market. But what is understood from the historical experiences is it cannot give a full exposure to that commodity, because whatever the share price fluctuation need not be in correlation with the underlying commodity price fluctuation. That has been proved historically, that there is no perfect correlation that is coming out between the underlying commodity price fluctuation vis-a-vis the share price fluctuation of that particular company, because most of the times what we experience is the share price fluctuation apart from the underlying commodities fluctuation is directed by various other unique risks that could be specific to the company or something relating to the market or various other things, need not be exclusively because of the change in the price of the commodity. So which means buying the shares of a commodity company may give some kind of an exposure to the underlying commodity, but it may not be a complete exposure. And it is also found that historically the returns are very less for investing in stocks of the commodity companies rather than the direct investing in the commodities. So some disadvantages, whereas some advantages associated with that kind of an investment. Now the third mode which participants can get into a commodities market is by buying some commodity based mutual funds. So instead of buying shares of one company which is dealing in commodities, we are trying to invest in shares of multiple companies which are dealing with commodities. So it's more of a diversification kind of a mechanism. So investor can either enter into it on a passive note, means the investments are purely based on some commodity index, or they can be actively managed also. A portfolio, the fund manager can very well plan out the investments in the various companies which are dealing with the commodities. Or sometimes there is a concept of commodity trading advisors, where the pooled money is used to trade in commodities using different strategies, not just one strategy. It is investing in various commodities using various strategies, and because this is a mutual fund, the transaction costs are much lower, but a diversification benefit is going to be much higher. But the main drawback that can come out is, and there will be a lot of such mutual funds that are floating in the market. So understanding or having a good awareness of the investment strategy of that mutual fund, their composition, all these things will definitely differentiate which particular fund to choose from a set of all the available funds. So investor has to be more vigilant from that particular dimension. And the other way to get an exposure to commodities market is participating in the commodity futures. So it's not direct investment in the commodities, but it is more into the futures market. So the advantage wise, in the futures market, the whole money need not be deposited today. So it's only an initial margin that needs to be deposited. So to get an exposure to $10,000 worth of commodity, hardly you may have to deposit $1,000 as the initial margin today, and any price increase or decrease will be reflected to your account accordingly. A typical futures market transaction. So because of this, just with $1,000, the transaction worth $10,000 is being done on the commodity market. So exposing yourself very heavily to the commodities market, and the leverage is very high, right? In this case, the leverage is very high. So sometimes it can lead to abnormal profit, sometimes it can lead to abnormal losses. So there is a benefit as well as a loss because of this heavily leveraged position. And just like any other derivatives transactions, the transaction costs are much lower, and because of the volumes that are occurring in the derivatives market, they are very liquid. But in this also, the participant needs to be slightly more active, because especially when the rolling of the futures contracts is happening, closing the existing maturing contracts and reopening the new ones. So when the rolling of the futures contract is happening, means this month futures are closed, next month futures are opened, and again in the next month futures are closed, the next month futures are opened. This is a continuous monitoring exercise, which means the participants have to be active at least for some periods of time, which will give them some kind of benefit by investing into the futures market. Then the other kind of advancement, the same commodity futures, but commodity future indices. There are a couple of indices which are very popular with respect to the commodity future contracts. Goldman Sachs Commodity Index, Dow Jones AIG Commodity Index, these are all very heavily popular commodity futures indices. But of course, just like any other index investment, to a large extent it can be a passive investment mode. And because these indexes are based on futures contracts, which generally are dominated by the near term expiring contracts, what we generally find is these are very much suitable for short term future contracts itself. So for an investor who is more looking forward for short term futures investment, this investing in the commodity future indices is more and more effective. There are two ways of getting into that kind of investments. There are so many ETFs based on an index, exchange traded funds. So because they are exchange traded, the risks are much lower, and they are based on a commodity index. So it's a more of a passive kind of an investment. The transaction costs are much lower, just like any other exchange traded fund. The transaction costs are much lower because it is generally a passive kind of an investment tracking a commodity index. So the credit risk of the issuer is generally not a concern in this case, and whereas the biggest concern here is the composition of the index. How is this commodity index constituted? What kind of commodities have gone into it? What is the rebalancing strategy? What is the calculation methodology of that particular index? So getting into the details of the construction of an index is a very key factor as a part of the ETF investing. Whereas the other form of investing in commodity future indexes is through a commodity index certificate, which is issued by the banks who will collect the fund from the investors and invest it in the futures market. And whatever the returns that are being generated on this, they are based on the excess returns, right? They are not based on total return. Means they will not include the collateralized return. We'll talk about it. It only includes the spot return plus rollover return. So they don't consider the collateralized return. In case they consider the collateralized return, it is called as a total return. But this index is purely based, the commodity index certificate is purely based on excess return, and it is exposed to the credit risk of the bank which is issuing this. So the issuer's credit risk forms an important aspect in this commodity index certificate. Returns are low, but the disadvantage side is because it is purely based on excess return. What we see is when the interest rates are very high, the returns of this are much lower, and when the interest rates are lower, the returns are higher. So means especially in terms of growing interest rates, this is typically not so advantageous, because in case of growing interest rates, the collateralized yield is going to be much higher. So the total return will be much higher, but the excess return may not be that higher. So any index that is based on total returns is much more advantageous rather than only the excess returns. Then the next aspect that we are looking in this context is the definitions like the contango and backwardation. These are the two situations where the futures market operates. These are the two terms that are being used to describe whether the futures price is greater than the spot price or the futures price is less than the spot price. So generally for that we talk about something called as a commodity term structure, which is nothing but, okay, today let's say this is December. Jan futures, February futures, March futures, April futures. I'll find out what are the prices for each of these futures. If I see that the future prices for these four maturing contracts is following some kind of a downward sloping kind of a graph, I say that this particular commodity market is in a backwardation market. But if I try to plot the futures prices for the different maturities, which is called as a commodity term structure, if I see that this graph is an upward sloping kind of stuff, means the longer term futures are more priced, are having a higher price compared to the shorter term futures. So in that case, I say that the commodity market is in contango. So in case of backwardation, we always see that the forward price is less than the spot price, whereas the forward price is greater than the spot price in case of contango market. And we see a falling trend in the commodity term structure, whereas in case of contango we see a rising trend. And when will the prices be falling like this? When there are more and more of short hedges, means lot of people want to protect themselves against the falling prices, right? So a lot of sellers, producers of commodities. So when the market is dominated by more producers willing to protect themselves against the falling prices, it indicates that in the future, so if at all the buyers have to be compensated for taking the risk, their prices should be much lesser compared to the existing spot price. So what we see is a kind of a backwardation or a falling trend in the price. But if the more commodity users, so basically from a hedger's dimension, if majority of the hedgers are getting into a short hedge, we see a kind of a backwardation position. But if we see majority of the hedgers getting into a long, which means from a consumer of the commodity perspective, many consumers want to protect themselves from the rising prices in future. So if the market is dominated by more of short hedgers, we see a backwardation possibility. When it is dominated by more of long hedgers, we see a contango possibility. So as we all, and if I have to link it with respect to storage, non-storable commodities, when I am looking at non-storable commodity, obviously it is better to consume it today itself, otherwise I need to have a big advantage to store it. So generally we see non-storable commodities forming a kind of backwardation, whereas storable commodities get into a contango position in a large number of cases. And just to find out the relationship that is existing between the forward contracts and the spot price, the forward price or a futures price is equal to the especially for the commodities, spot price into e power r risk-free rate of return, u storage cost minus y the convenience yield. So if the convenience yield is much higher compared to the risk-free rate and the storage cost, means if at all it is really beneficial for me to hold the commodity because it is not because of its lack of availability in future or various reasons, if at all I see there is a lot of monetary benefit holding the commodity today rather than buying it in the future, I see that the convenience yield is much higher, which could result in a fall in the futures prices, which could result in a backwardation. But if if it is storable and the storage costs are going to be much higher for it, it's very much possible that the futures price is generally more than the spot price itself, thus resulting in a contango position for that particular commodity. So the term structure, especially how the futures prices move for different maturities, it is very heavily influenced based on the convenience yield also, how people typically look at the future availability of that particular commodity. So we have to really assess whether that particular commodity is in a contango position or in a backwardation position, and so based on that our position with respect to long versus the short needs to be evaluated. Then whenever we are trying to look at the overall return that the commodity is generating, we break up that return into 4 parts. Any commodity investor, if I have to assess the return on a single commodity, I try to look at the 4 important components. One is the spot return. Spot return is nothing but, probably sometimes people also call this as price yield. Because of the change in the futures price compared to today, spot price and the futures price, whatever is the change that has come up is what is contributing to the spot return. I mean, the same commodity today is $100, so the futures price today is 100, whereas the futures price on the expiry date is 120, then the difference between the two, which is 20%, is contributing to the spot return. It's a direct change in the spot price or change in the futures price of this particular commodity, so which is impacted by various things: demand and supply changes, unexpected inflations, economic development in the country, seasonal factors for some kind of agricultural commodities or something. Seasonal factors are probably weather or some kind of political instabilities, and various things can contribute to the spot return. So if at all I have to assess the spot return, it is purely because of the change in the demand and supply factors for that particular commodity. Then the second item that is of more importance to be looked at is from the perspective of the rollover return. See, generally what happens in futures contract is, let's say if it is maturing on this day, let's say I have got into a long position here. So I am closing the existing futures here, means I am getting into a sell position, and immediately I am reopening a fresh long position. So what is happening here? I am selling it at some price, and again I am buying it at some other price. So when I am selling it, when I am closing out my existing position, there are two things. When I am closing out my existing position, the change in the price here, when I have got into a long versus when I am got into a short here, the difference is what is actually creating to the spot return. But when I am reopening it here, there is a benefit that I am getting on the margins that I have to deposit. That is what I call as a rollover return. So especially when the market is going more and more into a backwardation kind of a scenario, here I am able to sell it at a high price but reopen it at a low price. Close the position at a high price, reopen a new position at a low price, means there is a return that is coming. This return is positive when the market is in a backwardation, whereas it is negative when the market is in contango. The typical way I compute the rollover return is the spot price on the maturity date, means the futures price of that period, means spot price and futures price will be same on the maturity date. So the spot price on the maturity date minus the futures price for the nearest month contract, next futures contract. So if this is more than this, means this is an indication that the futures market is in a backwardation. So there is a possibility of a positive rollover return coming up, and if it is negative, or probably if the market is in contango, the futures price will be greater than the spot price, means there is a possibility of negative rollover return. So this is one more return that comes up because of closing the current term contracts and reopening the later term contracts, especially in a case of rolling over of your futures contract. We find the rollover return, and just to understand it simply, it is positive in case of a backwardation market, whereas negative in case of a contango market. Then the other form of return that we are looking at is the collateralized return, or just to even stop it here, when I talk about the excess return mechanism of commodity, we look at only the spot return plus rollover return. And this is a very interesting aspect, the collateral return. See, what is generally happening, let's say I have got into a long position in the forward contract, in the futures contract. All I need to deposit is not the full value of the commodity. All I need to deposit is only the margin, which will be not more than 2 to 5% or at the most 10% of the worth of the commodity. So which means the remaining 90% of the value of that commodity is already existing with me in the form of cash. Now what I can do is I can invest that cash to earn some interest when I have got into a futures position saying I'll buy the commodity, let's say after 3 months, for this 3 months more than 90% of the cash is available with me. So I can deposit that cash to earn interest for a 3-month period. That particular interest that is getting earned because of getting into a futures market and not getting into a direct purchase of the commodity is what we call as a collateralized return. Generally we equate it to the risk-free rate of return for that much period, which could be a treasury bill rate. It's basically I am collateralizing the position with by getting into the treasury bill investment, which could give me a slightly higher amount on the day I have to purchase that particular commodity 3 months later. So my position is increased by the extent of that extra interest that is getting generated. So that kind of a return is what I call as a collateralized return, which is also included as a part of the total return index, whereas the excess return index does not take into consideration the collateralized returns. It takes only the spot return as well as the rollover return. So because only margin needs to be deposited, that excess amount can be used to earn interest, and that is what is giving rise to a collateralized return. Then one more interesting aspect looked at from the perspective of a return is especially applicable to a portfolio, rebalancing return. See, most of the cases what will happen is when a portfolio is created, different commodities contribute to different weights based on different factors. Let's say when I am talking about a value weighted index, value weighted portfolio, what it generally goes with is, okay, the value of each of the commodity as a proportion of the total value of the portfolio is generally fixed. So any particular commodity whose value has gone beyond that limit, there will be a sale that would be happening, and any other commodity whose value has gone down, the purchase happens on. So wherever the sale is happening on that, it is contributing to a return, and when the prices have gone low, we are talking about a purchase of that. So that again the composition, the value composition of the various commodities as a proportion of the total portfolio is remaining constant. And because the commodity prices generally are mean reverting, and the correlation between the various commodity prices is assumed to be low, what is generally assumed is any commodity whose value has gone up generally will come back, and any commodity whose value has gone down generally will rise up, which means there is a possibility that you have bought it at a lesser price, and because of mean reversion at some point it will come back and it can even go up, at which it is sold, which is again creating a kind of a return. So this kind of a return that is getting generated because of the rebalancing of the portfolio based on some strategy. I am not bothered, I have used only a value weighted portfolio as an example, but typically any strategy where you are earning a return because of the rebalancing of the portfolio is what is contributing to the rebalancing return. So as I have already said, for an individual commodity, when I look at only excess return, the focus is on spot return and the rollover return, whereas when we look at the total return, we even include the collateral return. So whenever we are talking about the total return index, this should be the index that should be used for comparing commodities performance with the other asset classes, because we have to look at the commodity as a fully collateralized position, wherein the cash is actually invested to earn some interest, and whatever the commodity is earning, everything is contributing to the total return on the commodity. So when we look at the various theories that are governing the commodity investments, there is one which is called as insurance perspective, especially when the commodity sellers, they go for a short hedge position, which is protect themselves from falling prices. They look at getting into the commodity derivatives market to protect themselves from falling prices. If because of these kind of people, there should be someone who has to take the risk and give them the protection. Those are the speculators. And because this position wants to protect themselves, the sellers wants to protect themselves. Obviously, if the futures price is same as the expected spot price, obviously there is no motivation to the speculator to take the risk. So the futures price should be less than the expected spot price, which means the speculator who is actually buying it at a future date, he has to buy it at a slightly lesser price than what is the expected spot price, which means that is the premium which the speculator is taking to act as a buyer at a later date, to act as a buyer to this seller's transaction. So the futures price will be slightly lesser than the expected spot price, which will create a kind of natural backwardation in the market, because as per the parity theorem, futures price should be equal to the expected spot price. But because of the insurance kind of model that is being sought by the commodity sellers, what we see is the futures price will be slightly lesser than the expected spot price, which means getting into a long position in the commodity futures always can generate considerable profits. Whereas the other theory, which is an extension to this, is why do you look at only the sellers wanting to protect themselves from falling prices? Why not the buyers protecting themselves from the rising prices? The consumers of the commodities also want to protect themselves from the rising prices. So generally they get into a long hedge position. So when they want to buy it at a lesser price. So because of this, the someone who wants to take a risk to give a risk protection to these set of hedgers, they expect a premium out of this transaction. So which means the futures price cannot be exactly equal to the expected spot price. It has to be slightly more than the expected spot price. So in that scenario, when there are a large set of consumers who are getting into the commodity futures contract into the long hedging position, more number of speculators exist who are willing to take a risk only if the futures price is greater than, they are compensated slightly more than the expected spot price, the premium for taking on that additional risk. So they should be compensated for that additional extra risk that they are taking, which means the futures price should be greater than the expected spot price, which could result into a normal contango kind of a position, which means depending on whether the producers who want to hedge themselves against the falling prices or the consumers who want to protect themselves from the rising prices, out of these two sets of people, depending on who are more in number on the futures market, the market will follow either a normal backwardation or a normal contango kind of a process, which means as an investor I can benefit based on both long position as well as short position in the futures market, depending on who are more. If the sellers with a short hedge position are more in number, probably futures price will be less than the expected spot price. A normal backwardation will result, which means long position can generally benefit. But if I see consumers with a long position in the futures market more, then futures price will be greater than the expected spot price, giving rise to a normal contango position. So a person who has a short position in the futures market will definitely benefit out of it. And one more interesting theory with respect to the futures, with respect to the commodities market is, which we have already dealt earlier. Difference between the futures and the spot price is purely because of storage costs and convenience yield. So if the storage costs are very high, means if it is a non-storable kind of a commodity, obviously the inventory levels will be much lesser, which is giving rise to high convenience yield and vice versa. So it is even observed that there is an inverse relationship between inventory levels and the future prices. So inventory levels high, future prices lesser, convenience yield is going to be lesser. As long as this relationship is understood in stronger terms, probably the commodities understanding becomes more and more easier. So that is what I would like to talk about with respect to basic introduction to the commodities investment market. I hope a good level of clarity came into this particular aspect. If you have any further clarifications required regarding the same, you can get back to me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.